Have a lot of important stuff to go through this morning. Daily financial news for March 15th. We have to start with a reminder. Remember from over the weekend, I asked you to step back, take a deep breath, pause. There are lots of scary headlines going on. I will admit some of the headlines are getting worse, not better. But remember, where there is great pain, there is great opportunity. Where I have seen investors miss opportunities in the past is when the negativity, or as Warren Buffett says, when the tide goes out. You and I get interested in the tide going out instead of the opportunities left behind. So remember, take a deep breath. I will share with you all the negative information in a hopefully actionable way. We will also, because we do this daily, we will be able to tie things together over time. You can go back on my playlist, the Daily Financial News, all the way to pre-pandemic to see what we are talking about and get history of what is going on. All you have to do is search by date on my channel. That's why we have 10,000 videos, because we've been doing this for a long, long time. So again, I just want to remind you, take a deep breath. It is my belief that we are in something very similar to the 1980s, 1981, which is unfortunate. It is unfortunate because the best analogy I have so far, and if you have a better one, please tell me, is we are driving in dense fog. And unfortunately, sometimes in dense fog, two cars collide, and then little by little, we have a monster pileup. In my opinion, this is not the Great Recession where there was one moment called Lehman that all hell broke loose. I'm actually not sure what's better or worse, but unfortunately, I believe what we are going to be talking about is very much like the S&L crisis. Please research it. I know there's lots of channels out there that want you to believe this is the Great Recession. That is recency bias. The environment we are in today is what? We are raising interest rates at a record clip. Why would you look at the Great Recession for that? This is 1981. What happened in 1981? You and I had shit returns in savings accounts. So what did you and I do? You and I bought treasuries or CDs or whatever. That is what's happening today. We are taking banking deposits out of savings and checking and money market accounts, and we are buying treasuries. That is sucking liquidity out of the bank. It is making savings look lower than it reality is, and that is causing banks pain. So again, take a deep breath. Do yourself a favor. Do not get caught in the Great Recession nonsense. Please. Please. Now, many of you weren't even born in 81. So please go back and look at the S&L crisis, because it is eye-opening for duration, a decade, and 3 different distinct recessions. So please educate yourself. Take a breath. All right, with that, let's get started. So I don't know if you've seen the news this morning, but Credit Suisse is in some pain. Credit Suisse, frankly, has been in pain for a greater part of a year. Their big backer, Saudi Arabia investment arm, has said, we are not giving you any more money. Of course, their banking CEO says, we are liquid and strong and yada, yada, yada. Honestly, I don't know what he's supposed to say, but when I see lots of bank CEOs get in front of TV and say those things, I have PTSD to flashbacks. So I'm not really sure what they're supposed to do, but it is what it is. What I want to say about Credit Suisse, unfortunately, it is my belief that on a scale between Silicon Valley Bank, Signature Bank, and Credit Suisse is, I'll steal a Grant Cardone quote, 10x worse. Why is that? It is my opinion that Credit Suisse is one of the 20 most interconnected banks around the world. And it is this interconnectivity that could cause big banks like JP Morgan, Citi, Wells, Morgan to have some pain. Silicon Valley Bank was a net positive for the big banks. Credit Suisse, in my opinion, my educated but not in the weeds opinion, will have impact on big banks. Credit Suisse, in my opinion, is worse. Second, remember, I have studied economics, got an MBA degree. What does all of that mean? I have learned that economics, a lot of people talk about economics today on YouTube and they focus on the numbers. Now, the numbers are important, but they are always a look backwards. I look at them, we talk about them. In fact, we'll talk about a couple of today. But where I focus and what makes my opinion, the position unique, is I study consumer behavior. I believe an economy that is 68% consumers, if you can figure out what's going on in the lion's share of its citizens, you can make educated guesses that, if you've been on my channel a while, have a pretty good history of being correct. So what does that mean here? Silicon Valley Bank, Signature Bank, bank run, all of this stuff scared consumers. The powers that be came in on Sunday and tried to throw a wet blanket on fire. I think it helped. It certainly didn't stop consumers from talking about it. It helped. However, now you have the next domino. This is the slow pileup on the fog freeway. Credit Suisse. And they won't be the last. Again, Credit Suisse, one of the 20 most interconnected banks, in my opinion. So, I believe consumer psychology is going to be dented even more. What happened? Ask yourself this question. When you are scared, what do? Most of us retreat, conserve, don't move. I believe what is going on right now is crushing consumer sentiment, psychology, confidence, whatever you want to call it. Consumers are spending less money right now. Now, the numbers will show in the weeks and months ahead, but I believe that's going on right now, and we will see recessionary indicators possibly as soon as Q2, but certainly by Q3. Second, what is going on in the lending market? Because of Credit Suisse. I believe it is going to get even more restrictive, even more expensive. I believe the divergence between first-time home buyer, FHA, Freddie, Fannie, all of that, and investors will widen. I also believe rates will go down. Now, rates going down is important because what did you and I uncover about a month ago? Sub 6% 30-year mortgage is a problem for housing. Sub 6% is a problem. And as you heard me in very early January, I guessed, one of my top 12 guesses for the housing market is we would see the 30-year mortgage average below 6%. I believe we could be there within the next 30 days. And folks, if you did not watch Beth Traverso and Omar's video yesterday, you need to go to their playlist and watch them. Omar works in the high desert of California. His inventory, his active listings have dropped 15% in 4 weeks. Beth, who works in the Seattle area, inventory has dropped, active listings have dropped 45% in 4 months. Just like I said. Sometimes I enjoy being right, but sometimes I know there's implications behind this, and this is rough for first-time home buyers. Unfortunately, as I've just said, I think it's going to get worse. It's going to get worse. Let's keep going. So again, Credit Suisse is just the next domino. I think it is a more important domino because of interconnectivity. So more on that, I'm sure, in the weeks to come. Let's talk about PPI. Let's remind you what PPI is. It's the Producer Price Index. What the hell is that? Think about going to a store. That, and you buy something. That counts as retail or CPI, Consumer Price Index. That store when they buy goods, that is producer price index. So think of it as a chain. Producer price index is a leading indicator. It is a wonderful leading indicator. What happened in PPI today? Well, let's get into it. First, the expectation for PPI was 5.4%, which would have been down from the month prior. It actually came in at 4.6, or 0.8 of a point low. This is a huge beat. Jerome Powell is smiling. Jerome Powell is smiling. It came in month on month. Month on month expectations, headline was 0.3. It came in at negative 0.1. That, folks, is deflation. Negative number. Again, Jerome Powell is smiling. Now, core. Now, you and I have talked a lot about core, right? X food, X energy. Core was expected to come in at 0.3 positive month on month. It came in at 0. Jerome Powell is smiling. Folks, there is no other way to look at this. Jerome Powell is smiling. Actually, I didn't have on here, but we will talk about it right now. Retail sales. There were two important reports today. PPI and retail sales. Retail sales, remember, in January was a barn burner. I think they were up 3.2%. It's like, what the heck are consumers doing? Guess what happened in February? Folks, it was down 0.4%. And it is my opinion that March will be much, much worse. Again, why? See earlier discussion. I believe this banking crisis, the follow-on with Credit Suisse, the drops in the stock market is going to cause you and I, the consumer, the average American, to pull back. And where do we pull back first? Discretionary retail items. This is all leading to the Fed winning. It just is. The Fed is winning with the data we have at hand today. We should all be thankful. Why should we be thankful? Because the Fed will not have to go as high. Now remember, you and I have been talking about 5% for months, and I never wavered. I still haven't wavered. That is where we are going, which means we are almost there. We will be probably one interest rate raise away after next week. In fact, it is now even money if we pause after next week. We needed to get to the terminal rate to figure out what we have, and we are almost there. That is good news, in my opinion. Next, let's talk about home builders. How many crash bros are no longer talking about existing home sales, but they have pivoted to home builders, right? All the home builders, they're going to die, they're going to fall away, blah, blah, blah. They do not understand. What have you and I been talking about home builders? I have been telling you they are going to surprise to the upside. Why? Two reasons. One, they're going to slow down construction. They are going to conserve cash. Two, they are going to buy down rates. Instead of discounting prices, they're going to discount rates so the client, the buyer, gets a better payment. And then finally, as we've all talked about, I believe rates trend lower. So what happened yesterday? Lennar, one of the big builders, Lennar came out with their earnings. They did $6.4 billion in top-line revenue. They made $2.06 a share. Both of those beat expectation. Both of those are barn-burning numbers. That doesn't seem like a crash to me. What else? We have deliveries. Deliveries last quarter were up 9%. They delivered just over 13,600 homes. New orders fell, dropped 10%. Frankly, that is a good thing for the home builders. They are slowing down. A drop in orders is to be expected and frankly was forecast. Backlog dropped 29%. A lot of that is because they're not piling on new orders. Next, John Burns, Real Estate Consulting, specifically a great follow on Twitter, Rick Palacios Jr. He has been on this channel. Home builders to gain market share. This year, Today they total 11% because of interest rate lock-in and no existing inventory. Folks, if you took the time to watch Brian Lebo's summary of the Las Vegas market, he summed it up quite well. There's no existing home sales at a good price, so go buy from a builder who can buy down the rate. This is what I've been trying to tell you, is in the environment we're in, where this interest rate lock-in, where there's no active inventory, builders are going to profit. This is like the perfect environment to be a builder. Build slowly, commodities are coming down, interest rates are coming down, and you as a builder can do rate buy downs and get somebody into a payment with an interest rate sub 5%. Builders are going to win in this environment. And if there is a builder who decides to build smaller homes, they will crush it in this environment. Okay. Oh, mortgage apps. I don't know if you saw this, but mortgage apps are up another 7%, I believe. Let me get it right. Yep, nope, 6.5% week on week. They are down 38% year on year. Folks, this is the spring selling season. Who is showing up? Buyers. Who is not showing up? Sellers. As we've discussed, Seattle inventory is down 45% in 4 months. The high desert's down 15%. I suspect most markets, and you can tell me, you can leave the comments, your active inventory, is it up or down? And of course, remember what I keep trying to educate the audience is there's 3 markets. There's luxury, there's move up, and there's first-time home buyer. All of you are telling me the first-time home buyer is scarce. And if rates get below 6%, I don't have good news for you. It will get worse. Inventory is crashing. I want to hear from you. So again, remember Beth said Seattle inventory. Seattle's a monster market. Seattle, I think she told me, had like 1,400 listings or something like that. It's in a high desert had like 900. These markets are millions of people. Millions. And it includes luxury. This is wild to look at. And again, you can follow folks like Lance Lambert, Logan from Housing Wire to kind of get weekly updates. They are amazing follows on Twitter. Shout out Lance and Logan. Let's talk about CPI. So I dug into CPI yesterday. Remember, folks, headline CPI yesterday was 6%. If you look under the covers, I saw what I thought I would saw. I saw what I thought I would see. Anyways, whatever. What were we talking about? Remember, goods inflation is over. That got us to 6%. There's this second bucket called housing. So what was housing inside CPI yesterday? It was roughly, let me make sure I get this number right. Housing cost was about 70% of inflation in February. That is great news. Second, as I predicted, shelter is still going up. Think of it like a roller coaster, right? Just the way it's calculated. So, right, inflation is on a 12-month thing with housing. We are still peaking. I thought yesterday might be the peak. We won't know for a month. Why is that important? Because once it rolls over, it's just like a roller coaster. You will see the second part of inflation get better. We could go from 6 to 4% over about 4 or 5 months. But then, as I have told you every time, that next 4% is going to be hard. It is going to be really, really hard. Think services x housing. We have at least a year, and I would think 18 months to have that slowly chip away. We may not see 2% inflation until 2025. So, again, generally speaking, Jerome Powell is happy today. CPI met expectations. Housing is the lion's share. He knows that will roll over. PPI, big beat to the downside. Retail sales to the downside. Going on. Credit Suisse is a problem. It is, frankly, in my opinion, a bigger problem from Silicon Valley Bank. Take a deep breath. Don't lose yourself in the negativity. Remember, when the tide goes out, most people get scared and do nothing. Don't be them. Look where their water was and see if there's any diamonds or gold bars to pick up. You don't have to pick them up, but Get out of the negative news cycle. Where there is great pain, there is great opportunity. I have done this repeatedly and am comfortable doing it. As evidence, I proved it once again. In November of last year, when Yahoo Finance said 87% of home buyers think it is a bad time, I got pissed off. So in the matter of 3 weeks, we bought 2 deals on the MLS. Everyone on the planet could have bought these. We bought them for 30% below list price. I have already flipped one and sold it and made roughly 40 grand. The other one is in escrow. We opened escrow yesterday and we will make more money. Folks, when everyone is scared, they stop looking. Just do the work. I am not telling you to buy. I am telling you, I am imploring you, I am asking you to do the work. Now, if you want help with this, you want to know what the buy box is and all of those things, I have a first and only event coming up next Sunday. I think it's March 26th. 47 of you have already signed up. I'm only doing 100. So we have 53 more spots. We are going to go for 2 hours. We are going to build a buy box together. I hope, because I'm doing it as a meeting, not a webinar, that I can pull up your buy box, look at your buy box, have you answer or ask questions about your buy box. We are going to go deep for 2 hours. Then we are hopefully going to have time to take the buy box findings and start creating the spreadsheet that will become the thing that you inventory and build and understand average. Remember the conversation with Matt and Dion yesterday. I have always said the buy box is learn average so you can do great. The lumberjack correctly said, Michael, you're missing the point. The buy box allows you to avoid bad deals. He's right. It is an insurance policy. Don't gamble. Don't say, hey, I've been doing the work. I need to buy something. I'm going to lose money, but it's the cost of admission. Don't say things like that. Do the work. So again, it's on Eventbrite. I put the link below the last couple of daily financial news. I'll try to remember to do it again today. But there's only 53 spots left. 2 hours, the 26th on Sunday. We will do it from 8 to 10. There is a cost. It's $47. I want to keep the, you know who they are. I want to keep those people away. So we're going to do this together. We're going to help at least 100 people. So folks, again, take a breath. Where there's great pain, there's great opportunity. It's okay. We've been here before. Good times never last, but also bad times never last. All right, folks, take care of yourself. We have lots of great conversations today. The one and only Anna Kelly, Adrian. We're going to talk to the lumberjack again, and of course, Matt, the mortgage guy. So take care of yourself. We are talking to millionaires today for you. Bye-bye.